Hey folks, David Frost, my strategic forecast. You're here for another episode of Common Sense Market Analysis. Today is Thursday, May 17, 2018. You're looking at a daily chart of the SPY or SPDR, which is the proxy for the S&P 500. And the market across the board today was really quiet. Not a lot happened at the end of the day. There was a little bit of back and forth behavior during the day, but at the end of the day, markets finished near the flat line. There was a couple of rounding errors here and there. The SPX was down 2 points. The Dow was down 55 points. NASDAQ was down 15. But these are minor moves, and these are really just a quiet day and a lot of computerized trading, I have to say. For the most part, there just wasn't a lot of institutional participation going on today. The SPDRs had 56 million shares traded. That's a very light day. It's similar to yesterday, similar volume. So what we'll do tonight is we'll talk about where we are. We'll talk about both possibilities. And then I'm going to do a couple of things a little more in depth. Since there wasn't a lot of movement out there in the market, I want to use that time to actually use it as a teachable moment. Use it as a lesson on a three-legged trade that I actually took today. I'm going to go over the trade. There were three trades on the same symbol. We'll call it a symbol. I'll get to it when I get to it. And I'm going to go over all three legs. There was a down leg, and there was an up leg, and there was another down leg. And I'm going to explain the whole thing because the entire trade was right out of the course at lazyeMinitrader.com. It was picture perfect. There were three setups this afternoon that all worked out, and I'm going to explain why. The other thing we're going to do is we're going to answer a question about confidence, and it's really a question that comes to me often. It comes to me kind of all the time. And the question is, why do I lose more on my losing trades than I win on my winning trades? I can't seem to flip that around. What should I do, or how do I address that? What can I do? I get that kind of question all the time. We're going to talk through that, and I'm going to try and answer at least part of it from a psychological perspective. Let's get back into the SPDR. So we continue trading above the trend line, the downsloping trend line. As long as we do, it's very difficult to be bearish this market. Can we have a little bit of a dip lower tomorrow? Sure we can, but are we going to get below this particular trend line and the 100 period moving average that comes on right underneath it? Are we going to get below that and start closing below that? Eventually we will, but are we consolidating sideways to make another push higher to the 275 level? The longer we consolidate, the higher we can actually go beyond that 275 level. So that's another thing that's extremely important. And this is another thing that comes right out of the course at Lazy E-mini Trader. I'm going to touch on it here. I'm not giving you the whole thing, but I give you a little snippet of it. So if the market consolidates sideways, the time that it uses to consolidate sideways has something to do with the magnitude of the move that's going to come out of that sideways move higher. So, for example, are we going to get an equidistant move or a symmetrical move from like this one? Here's a leg up. Here's a sideways move. Are we going to have another leg up like that? Or is it going to be another distance or another measurement higher? Well, I contend it'll be a different measurement higher than that. But what I do say is the longer we consolidate sideways, as long as we remain above this trend line and continue to consolidate sideways to even slightly lower, but remaining to the north side of this trend line, then that's telling you that the market's setting up for another push higher and a release of energy to the upside. If we get below this trend line, below the 100 period moving average, then something else is developing, and we have our initial downside target, which will remain 266.50. That's a very important price level on the chart. Keep in mind that this week is options expiration week. You will have some volatility tomorrow. The majority of it will take place in the beginning of the day. We could have a dip lower, and if we do have a dip lower, will they come back to retest the downsloping trend line, the 100 period moving average? That's certainly possible, but what we have to keep our eye on for the bigger picture is where are they going to close the market? It's not necessarily how they trade them during the day that's important. It is important, but what's way more important is where they close them at the end of the day and where are they going to close them at the end of the week. And all that's going to take place at 4 o'clock Eastern tomorrow. So we'll be anxious to see where they close them tomorrow. Can they dip a little bit lower, retest the trend line one more time? Absolutely they can. Getting below it hourly during the day would be negative, of course. Closing below it tomorrow will absolutely be a negative sign for the market. And right now, that's how we have to read it. Now, technically, we're still inside of the high from the day that the market put in a pseudo doji candle. Technically speaking, we're able to take a short trade at that point in time. The next day, the market took a big dip lower. We bounced off the 100. And now, a few days later, what's happening is the complexity is different, or the makeup of the market is different right now. Now, had we had a second down day after the initial drop, things would have been different. But the market wouldn't give up the trend line. That's essentially what happened. You can see how the market's respecting, and it's not my trend line. It's the market respecting the trend line that it drew for itself. We got above that trend line, and now you see what was once deemed resistance to the market is now support because we got above the trend line. And it also makes it convenient for us because we know what the line in the sand is. Below the trend line, the market turns bearish. Above the trend line, the market stays bullish, consolidating, building energy for higher prices. Now we're looking at an intraday 10-minute chart of the SPY, the spiders. This is the S&P 500. You can also look at the ES, the S&P E-mini futures contract, all one and the same. I'm going to show you essentially 3 trades taken on this index today. And by the way, this is the stuff that's taught in the course at Lazy E-mini Trader. If you want to learn how to do this, you have to at least consider the course. What I'm about to show you applies on any chart, whether it's a stock, an exchange-traded fund, the Forex market, a commodity, the spider itself, IWM. It makes no difference. You see these type of patterns and you see these type of movements repeat over and over and over again. I'm going to go over these 3 trades right now. Now, I'm not going to give everything away, but I'm going to give you a lot in this video right here, right now. A little bit of a bonus. So the market makes a bearish pattern and begins to consolidate in a sideways fashion. This is a bear flag pattern. In the course, I teach a specific time period where this really begins to get where the trade begins to go in your favor. This is a short trade that had a high probability with a very defined stop out. Somewhere in the neighborhood of 30 cents. In the ES contract, the S&P E-mini futures, that would equate to about 3 points worth of risk on this trade. Now, the beauty of this trade was if you were using one of the strategies that I discuss in the course, you would have gotten 2 exits on this trade. So the market began to make a symmetrical pattern inside of a larger symmetrical pattern. So what happens is the first symmetrical pattern is this. So you have the initial down move, you go sideways, and then you have the secondary down move about equidistant to the first down move. That was your exit number 1. You also have this low point down here, the low portion of the green candle. That's a breakup candle, right? It's a breakout candle, breakup candle. I like to call them breakup candles. Markets like to come back and test the lows of candles like this. Well, what happened? You see where the low of this particular candle was? It was right around the low of that green candle. So you know that's your first exit. You have to take some profit along the way when you're in a positive trade. That's the first area where you're likely to get a reactionary bounce off that area because of the type of support that's there for 2 reasons. Number 1 is you completed the initial symmetrical move, and the second is you have the low of the green candle. So that's how we know where our target exit is. That's at least one of the ways we know a target exit. Now, all trades don't look the same, so target exits are going to vary depending on the chart setup. But on this particular trade, on this particular chart, that had to be target exit number 1. Target exit number 2 is the larger symmetrical move. So you're up here in the beginning of the day, you have a down move, you go sideways, and you have another down move. And is the first down move somewhere in the vicinity equidistant to the second down move? Yeah, I would say that jives to some extent. There's your second exit. Your second exit was, and you had a couple of different clues going on, your second exit was you were coming into where the secondary larger picture symmetrical move would complete. You had a pivot low down here that had to be considered another exit. You had a pivot low down here that had to be considered near another exit. You have a gap fill down here. So you know that somewhere in between here and the lower level, which is a gap fill, you had to exit the trade if in fact it's a day trade. Okay, so that's trade number one, over. Then the market proceeds to put in a pseudo doji candle, a tail candle. That's gotta have some meaning if I can find some other evidence that this really is support worth buying. Let's see what we find. So item number one is, again, when we assess the amount of time the market went from a specific pivot high to make the pivot low all the way down here. This pivot low that represents with the tail candle. So from a specific pivot high to that low, the market traded for right around or very close to a specific period of time that's discussed in the course at Lazy E-mini Trader. Time is much more important than price. I go over that in great detail in the course because in all three of these particular trades, time played a much more significant role than price did. So we're out of the first trade, but now I've got my eyeball on a potential second trade. We just put in a tail candle. Would I love to get a retrace down here? And I began to wait for the retrace, and then I had a sense, and it was just a hunch, that we weren't going to get the retrace, and I ended up buying right about here, right about equidistant to where the candle closed, the candle before closed, and I ended up buying and making the run all the way up, taking an exit at the 20 period moving average. Not at the 50, but at the 20. We'll get to that in a minute. When I took this trade, did I have a very defined stop loss limitation? I sure did. Any close below there. This is a 10-minute chart. Therefore, any 10-minute close below the tail low and I'm out of the trade, it was the wrong idea. That didn't happen. It was the right idea, but that's how you have to approach the trade. You have to know where you're wrong before you even get into the trade. If you can't get into a trade having an idea of where you have to cut and run, where you would have to pull the ripcord, then don't get into the trade. The first trade, I had a very defined area where I knew I was wrong. It was a close, a 10-minute candle close above the high of this particular red candle. If we got a 10-minute close above that area, I pull the ripcord, I'm out of the trade, bad idea, pattern didn't work out. In this case, the pattern did work out, but that's where I knew I would have to pull the ripcord. Now let's discuss the exit on the second trade and the third trade. So the exit on the second trade, now I had my eye on the 50-period moving average specifically because I had a feeling as the market was creeping higher that we were going to come into this area that we consolidated at just a little while earlier today. Like markets like to come back and retest former breakout and former breakdown points, right? I say that every single night. This is where the market broke down earlier today. Based on this 10-minute chart, that's a breakdown. We came right back to test the former breakdown area. I can't stress that enough. I say it every single day. And the reason I'm able to say it every single day is because we see the market do it every single day. So that's in fact where the market did go. Why did I exit at the 20-period moving average? Because I'm never going to be a pig about it, and I'm certainly not 100% sure that we're going to get to the 20-period moving average and that real breakdown area. We did, but you're never really sure, and I'm not going to leave the few pennies left on the board to be only left holding the bag. We've all been there before. I wasn't going to let that happen. I really banged out 3 really nice, easy trades in a row, was never out of the money at all on any of the trades to speak of. So what I did was I took the high road, exited the trade at the 20-period moving average, and I actually did reshort the market right after that when we hit up near the 50-period moving average, and we immediately, in the next candle, you see what happened. That was a small trade, but it was a positive trade at the end of the day. Now, I talk about shorting the market, and I talk about shorting the market in light volume. Today was light volume, and I know I'm going to get some emails. Why did you short the market in light volume? Because I had the setup. I still knew where I was wrong, and I'm willing to take, at least that's me, I was willing to take a 3-point ES risk. That's a 30-cent SPY risk. I was willing to take a 3-point S&P E-mini futures risk in order to take that trade to the downside. It was setting up perfectly. We were building a bear flag, and therefore I took the trade. We were consolidating right over the 200-period moving average, so I knew that wasn't going to be support. And there was just a lot of reasons to take the trade. Are we going to come back down to retest the low portion of this breakup candle? And that's what I saw happening. I saw the market consolidating to make a run for that candle, not knowing that we'd go lower. But if you've taken my course, you know that in one of the video lessons, I tell traders how to turn trades like this into risk-free, emotionless trades, because we're able to take some profit along the way and then never let a trade like that go against us. It enables us to get the most out of the trade when it is going in our direction. A lot of the things traders do, or one of the things traders do too many times, is they take profit too early. And that leads us into the second thing that I really wanted to discuss tonight. In light of the fact it was a quiet market, I'm going to use the time to really try and talk about some things that hopefully will help some traders. Hopefully the trades I went over on this chart here helped some traders. And by the way, there was another very specific timing condition that existed on the chart enabling me to take the last trade, which was a short trade. The market went up for a very specific period of time into a very specific and important area that we can know with a certain or high degree of certainty that the market's going to find resistance at that former breakdown area at the end of the day. We just look at a trade like that and know that the probabilities are in your favor, that taking the trade with several reasons in your back pocket as to why it should work in your favor is the right decision. That goes to confidence. Before I do that with the confidence thing and the last question I want to answer, the other question I want to answer, the other thing is when I'm looking at multiple time frames at the same time. I'm looking at the 60-minute chart at the same time I'm looking at the 10-minute chart. And what you also saw here was you see there was another area when you're looking at the 60-minute chart that even looked as enticing, more so on a 60-minute chart. And you can see here's that low from earlier today. This is that candle. And so when we came into that green candle on the 60-minute chart, that's further evidence that we're likely to find support at that level. Now, I waited till the 10-minute chart put in the tail candle. That's fine. But when you're looking for areas of support or areas to exit a long trade, you have to look at multiple time frames. This is something else that I teach my traders is vitally, vitally important. Teach you which time frames are important and why. Why do we lose more on trades where we lose than we make when we have positive trades that go in our favor? So the issue is there's a number of different reasons, and every trader is different, and we all do things that we regret doing after the fact. We've all made mistakes, and I've made them all. I've made every mistake that you've ever made, and I've made some that you'll never make. But I believe that question is answered by talking about confidence. And when we have confidence that a trade is going to work in our favor, that's the only time, in my opinion, that we can actually hold a trade to finality. Meaning, let's get the gain we're supposed to get out of the trade. It's not going to go there in a straight line. There's going to be back and forth, backing and filling, fits and starts. That's the way the market works. The market moves in waves. It moves in up waves and it moves in down waves. It does this on 1 minute time frames and it does this on 1 hour time frames, daily time frames, weekly, monthly, and beyond. So nothing changes in terms of how the market moves When you're focused in on a shorter time frame, you'll see the same movements that you see on the larger time frames. They just take longer on the larger time frames. But what happens is when we've lost on trades, we immediately begin to lose confidence. When we're positive on a trade, we want to win because we want to feel good about making the right decision. So even a small win ends up to be a win in our psyche, in our mind. So we're comfortable taking a win for $50 or $30 or $75 or $200 or whatever's relevant to you. Let's just say, for the purposes of this conversation, a good win for me is at least $300 on a trade. This is a scalp trade. I'm not talking about a swing trade. I'm not talking about something I might be holding for a day trade, but a typical scalp trade. I'm looking for at least $300. Obviously, it depends on your account size and the position size and all that, but we're going to use that number, $300. But sometimes, if I'm in a trade, and let's say I'm down on the trade, and I'm down for 5 or 10 minutes on the trade, in my mind, I begin thinking I'm wrong. And this is a hypothetical. I obviously think the same way everybody else does. I just happen to have a comfort level that I will see the trades that I enter work out because I'm confident in my work. I'm confident in the strategies that I use. But generally speaking, when I say it's all traders. It's all of us at the same time. We all think the same way, at least some of the time. So I'm down on the trade for 5 or 10 minutes. Maybe I'm down $100. Maybe I'm down $200. It's beginning to get uncomfortable. And now all of a sudden I'm beginning to think to myself, all right, let me just get back to even. If I get back to even, I'll get out of the trade. I'll go on to the next trade. I'll wash my hands of it and everything will be fine. And then the trade starts to go in our favor and that's fine. Goes back down. Now we're in the doghouse again, and we just don't feel good. And each and every time we get close to that flat line, the trade backs up again or the stock backs up again, and we end up in the hole. Finally, we get to the flat line. Now we get to the flat line, we're looking at the chart, and we're saying, hey, the chart looks pretty good. And all of a sudden, we say to ourselves, well, it looks like it's going to work out, so I'm going to hold it for a while. Now the trade gets above the flat line. Now we're up, and we're up $20. We're up $30. We're up $60. All of a sudden, we're up $115, and it drops back down, and now we're down $50 again in a flash, in an instant. And now we slam the table, and we say, this is unbelievable. It happens over and over and over again. Now we have that vision of another losing trade, and we're losing more confidence. We're losing more confidence. How do we get a small winner out of that? When the stock goes back above the flat line, we end up taking a small winner because we've had enough. We were in the trade for 20 minutes. We were in the trade for an hour and a half, whatever the case was, and we didn't like the feeling of the pain, and so therefore we wanted out of the trade, and we feel fortunate to get out of the trade with a positive, even though it was $45 or $75 or whatever it was. And then invariably what happens, about 15 or 20 minutes later, or maybe it's an hour later, we see the trade doing, or we see the stock doing exactly what it was supposed to do based on the reason we got in the trade, and we realize now we left $250 on the table because the trade finally worked out. And what didn't we have? We didn't have patience because we didn't have confidence. In my mind, those two things work hand in hand, and the two biggest things that traders fight with internally with themselves. So I thought it was important to touch on that subject a little bit. I'm going to talk more about that over time, but I would be interested to hear your comments. Make comments, post them underneath the video, because I think that's a great topic to open a discussion about and see what your thoughts are and what your experiences are. And believe me, I've felt all the pain. I've stayed in trades too long. It's where all my rules come from. All the rules that are found in both my courses, they all come from all the mistakes that I made, and I don't want anybody else to make them, and that's the whole point. Let's talk about the IWM for a second. We'll get back to the markets. Let's get back to some charts. So the IWM's on a breakout. I mean, what can you say other than higher prices are coming? We talked about it last night. It's not going to go in a straight line. We can have some fits and starts, but we should see 164 in the IWM and then even potentially higher. But I think there will be some resistance at 164. You know, the IWM in like the last 3 weeks, we've had like 2 down days. And so we'll see where the weekly close is. But if we close at above these highs tomorrow, meaning Friday's close, and I mean above these highs here, If we close up here and we don't have a collapse tomorrow, this is bullish and higher prices are coming. No two ways about it. It is my favorite market leading indicator, isn't it? So how can I say that new highs are coming or continue highs are coming without linking that back to the spider? And remember, when we took a look at the daily chart on the spider, the S&P 500, it's pretty clear that we can make a case for a bullish consolidation pattern going on. And the longer we consolidate above that trend line, the more likely it is higher prices are coming. I mean, what's the likelihood of the IWM going up another, let's say, $2.50 from here? Okay, maybe even more, but at least another $2.50 from here without the other markets following suit. That would be a little odd and unique, I would say. The transports, not a lot of change today in the transports. Tried to rally a little bit, tried to peek its head above the highs from the other day, but fell back down. We're above all the moving averages. We could be consolidating as long as we stay above these moving averages, namely the 100 period moving average. Then you have to believe this is consolidating to make higher prices. If we came back down and began trading below the 100, then something else is developing, and maybe we would be headed down towards the lower portion of the channel that exists here. So this is a channel, we talk about it each and every night. We're at the top end of the channel, but above all the moving averages, we're going to give the upside, the potential upside to the transports. If this consolidates sideways, looks to me like it's building energy to bust through the top end of this channel, just like gold busted through the bottom portion of its channel. So that's what I see developing here until and unless we come back in and challenge and get below these moving averages. Looks bullish to me. That's the stance I have to take looking at the chart. XBD. So in the XBD, we're starting to break out of the bull flag pattern that we talked about the last couple of nights. So we have an up move and we were consolidating sideways. We talked about this for a while now, even probably more than 2 nights. And now we're seem to be breaking away to the upside, away from that bull flag pattern. Is that going to produce a symmetrical move in the upward direction? We'll find out, but that's what is happening currently. We'll see what happens based on tomorrow's close. Tomorrow's an important close. We're above all the moving averages on the daily chart. Tomorrow's the weekly close. Look where the XBD is on the weekly chart. You know, it's interesting. We do have this weekly high here. If we get through that high on a weekly close, that's going to be very important and very bullish for the XBD. If we don't, then we could be up against resistance based on the weekly chart. We'll talk more about that on Friday evening. Did not have an up day like the XBD when you look at the XLF. The XLF was down a little bit, but guess what? We're just consolidating underneath the 100 period moving average. It's still making its bull flag pattern. Hasn't broken to the upside, and we'll see what happens, but this is bull flag pattern. Until proven otherwise, as long as we stay, at least for right now, above the 50 period moving average, that's the line in the sand that we'll use for this particular chart. The 50 period moving average coincides somewhere in the neighborhood of today's low was actually this green candle low. The 50 is a little lower than that. But it's interesting, we came in to test that today. What is that low? That low is 27.96. And today's low is 28 even, 4 pennies above that low, and we bounced pretty handsomely off that low. So that's a positive sign. That's a bullish sign. Weekly close will tell a lot. We'll talk more about it after the week is up. Looking at gold, nothing else happened in gold today. Really another flat day for the most part. Are we going sideways, building energy for another move lower? We could possibly be doing that. We'll come back to gold in the next Common Sense Market Analysis because there's nothing doing today. I'd rather talk about crude oil. Crude oil notched a little bit higher today, not much, but it is moving higher. And ultimately, we're going to get into the hot zone we keep talking about each and every night. Whether we get to 73 or we get right into the hot zone at 74, we're going to get up to that zone, and that's at the point we're going to be looking for signals of a trend change. Now, I'm not suggesting we're going from $74, $75 a barrel down to 10. That's not what I'm suggesting in crude oil. What I am suggesting is we should get a large enough move off that zone to produce a juicy trade. We'll look for signs of a reversal when one does exist. We'll keep talking about it each and every night until we get there. And with that, folks, it's everything I wanted to and intended to discuss. So I'm going to give it a wrap here. I'm David Frost, My Strategic Forecast. Thanks for tuning in for another episode of Common Sense Market Analysis.